Thanks for joining us. Today I'm speaking with Jason Beddow, who is the Managing Director of Argo Investments.
Hi,
Jason,
Tom. Thanks for having us in.
good to see you. And I suppose congratulations are in order. You've just days ago announced a record profit. How do you rate the last 12 months as an investing environment compared to the many years that you've been operating in the markets?
Yeah, good question, Tom. Look, the last 6 months particularly challenging. I guess through until last year, we had a lot of stimulus out of COVID and we had a pretty good recovery. Some of our result was the return of companies paying dividends that haven't. They're all in reasonably good shape. We've got reporting season now, I guess confirming that. The big miners had a windfall of iron ore prices and BHP and Rio paid significant dividends and we were a beneficiary and I guess we were able to pass that on as a record dividend to our shareholders. So, relatively good year. But yeah, definitely the second half. So I guess this calendar year, a lot of volatility, a lot of macro events playing out in the market's pretty whippy. So what was a good idea yesterday may not have been a good idea today. But we're investing for the longer term. So, we were pretty happy with that.
That's actually a good point that you make in terms of not being able to stay wedded to an idea for any lengthy period of time. So, famously, your organisation likes to look through a cycle, take a longer term view. What are the main themes in that bigger picture that you're looking at the moment?
Well, I think what's changed for investors and the world, and I guess even individuals, is interest rates going up and inflation. We're seeing some pretty big numbers around the world that we haven't seen for decades.
Yep.
And I guess the big debate probably in markets, and there's plausible arguments at both sides, is how far will interest rates go, how far they'll go, how fast, and the conviction of the central banks to maybe cause a bit of pain in the economy,
Yep.
Recession, unemployment, things like that. And we've seen the volatility in the market, if we just use June and July, as sort of months when the market stepped back thinking inflation was perhaps worse. And then within weeks or days, inflation may be controllable with the pathway and things are okay and equity markets have rallied really strongly. So,
Yeah.
And different parts of the market. Yeah, so I think it's pretty challenging short term.
So, I mean, within that picture, there's a great disparity as well between different jurisdictions. Just last night, the Bank of England, has suggested that inflation is not going to peak until 13%. The chances are that Australian inflation is going to peak well below those sorts of levels. It's quite a challenging picture to navigate within all of that. So, how do you position the portfolio to manage those disparities?
Yeah, I tend to agree. I think Australia is probably going to be, in a relative sense, better off than a lot of perhaps Europe with energy prices, inflation and food, as net exporters of energy and agriculture. But at the end of the day, if global markets are weak, we still follow the same trajectory, maybe just not as aggressively. But reporting season now, CBA itself had a good result only last week, and they put out a lot of data on the economy, and thus far the economy looks like it's holding up okay. So we think Australia is probably a relatively good place on a global scale from an equity investor to be. And dividends are back, which also softens the blow a little bit if you're not getting as much share price appreciation.
And obviously, financial hygiene is really important. And when you're looking at a rising interest rate environment, how are you positioning the portfolio in that respect?
Yeah, I think initially we kind of we always like companies with relatively strong balance sheets and good cash flow, but I guess we dug a little deeper to sort of go like who may need funding in the next 6 or 12 months. Equity markets may not be there for you, or not at the same price, and cost of debt's clearly going up. Had very little exposure there. If we look across, I guess the bigger cohort, the REITs and your infrastructure names are far better prepared for this than they were in the GFC. Much lower interest levels. Their debt's lower. They're termed out, and so we think corporate Australia is in relatively good shape. I mean, there'll be certainly pockets, and I don't think we really know where we might get to if we get to say the end of the year and inflation's a little stickier. Wage is starting to come through. Maybe oil rallies back as we go through a Northern Hemisphere winter. So we haven't sort of decided, but we think our portfolio is in really good shape from that perspective. And I think generally the Aussie market's in pretty good shape because I think CEOs and boards, have done that, and probably in the ones that have had pressure from shareholders to do that, or you're not getting your money, I guess.
Are there any parts of the market that you just wouldn't touch with a barge pole?
I still think the really growthy ends of the market that are EBITDA break even, getting to cash flow positive, are hard to value.
Yep.
I mean, some of the business models we think are quite good, and they're certainly more interesting now. They've fallen a long way. I mean, they've rallied back just recently. So we're trying to do some work on those, but getting a bottom-up valuation on them is really difficult. So, we want a fairly big, I guess, margin of safety or factor of us getting it wrong before we'd probably invest in those names.
You weren't that crash hot on the BNPL group in the past. Do you feel a sense of vindication today?
Oh, a little, yes. I mean, I still think at the end of the day, if you'd been an early investor in Afterpay, it's been a great outcome.
Yep.
But I think the reasons strategically or structurally we thought it was maybe not as good a business as the market was saying, and not tested in a rising interest rate environment. We think that's still held through, and in some ways, is being seen in the other listed players that are still around, who've shrunk materially.
Yep.
So not quite as easy in a different economic cycle, perhaps.
In terms of you mentioned oil prices a moment ago. There have been some profoundly impressive results that have been tied to the energy sector. How do you regard that particular space, given where oil prices have come from, and they've fallen quite a bit over the course of the last couple of months? How do you position yourself in relation to that thinking?
Look, we're relatively bullish, I guess, on energy prices. Clearly, LNG is going to play a bigger role for the next decade than maybe people were thinking sort of 12, 18 months ago with the push for renewables. I mean, they're clearly coming, but as we see with Europe, I mean, we're not ready yet.
Yep.
And Europe's probably got more renewables embedded in the system than anyone. So I think the Australian producers are in really good shape to generate a lot of cash.
Yep.
I guess the difference, though, is there's a whole cohort that don't want to invest in these companies or are looking beyond that. When you and I are driving our electric cars and things like that, that there will be less demand, and the whole ESG overlay that you're probably not going to get the share price appreciation you may have got in a different cycle.
Yep.
The beta's clearly less than one as opposed to multiples.
Yep.
In previous cycles, we just guessing, but if oil had gone to $100, I mean, the energy stocks would have more than doubled.
Yep.
They've moved 30 to 50%. So I think as an investor, you need to be conscious you're probably going to get your returns in a different way.
Yep.
Santos yesterday, Origin today, the numbers are like all the, I guess, any commodity-based company, when the prices run, the numbers are mind-blowing.
Yep. I mean, BHP with $24 billion worth of free cash flow.
Yeah. So we think they're just going to have to pay more dividends, buy back stock, and also have a very conservative balance sheet, because if they do want to develop assets, they're going to have to largely self-fund a lot of these things. So that's probably a little bit different as well. But I think constructively, what's happened in Europe with Russia and Ukraine, I think that's got repercussions for years. These things are not easy to fix. So energy security and supply, I think, is paramount. And I'm pretty sure if you're in Europe now looking at winter coming, how are you going to manage the economy with, as you said, UK inflation at 13%? I mean, not going to be easy.
It's going to be hard. So, to that point, banks have always occupied an important part of the portfolio. How do you regard their fortunes in that rising interest rate environment that is going to bite down pretty hard in 18 months' time when it comes to a whole bunch of mortgages rolling over?
True. Look, we think the Australian banks are in pretty good shape. They've all divested a lot of businesses, and I guess we probably didn't appreciate how much capital was tied up in businesses that actually didn't make a lot of earnings. I mean, the earnings of the major banks hasn't moved much for all the divestments, but they've returned all the capital. There should be some NIM expansion. We know it's competitive in mortgages, particularly now they're all sort of fighting for that patch. But again, if unemployment stays relatively low, and interest rates stay, I guess, within the bandwidth of what, I guess, a consensus or economists are thinking, sure, they're up. And, for people that took out a mortgage maybe in the last couple of years, that'll be pretty painful. But on a long-term run, if the cash rate gets to 3 or even 3.5, on a long-term chart, they're still fairly modest. Now, admittedly, there's a lot of debt in the economy. So yeah, look, there'll be some pressures on parts of the economy, but we think they're okay. I mean, historically, and it might be different this cycle, but when house prices are flat to falling, the banks don't tend to get a lot of share price appreciation, but you can be fairly confident they're going to, at least maintain, if not grow their dividends, probably through this cycle. So again, if you're looking for income and a bit of stability and you're a bit cautious on the market, the banks are probably, relatively okay.
That same house price performance has ramifications in terms of the consumer as well. The staples and the discretionary stocks have underperformed the market. Is that going to be an ongoing theme?
Well, I think so. I think while interest rates just continue to go up, I mean, we saw JB Hi-Fi's numbers earlier this week, and thus far the consumer seems to be still pretty happy to spend. Now, there's clearly a lag with interest rates to hit the economy. People have purchased a lot of goods over the last 2 years with COVID. So, you would think there'd be a natural slowing of goods purchases anyway. Interestingly, I mean, services are booming. Restaurants, travel is doing well. But you would have to think that, you look at fuel prices, your weekly shop, your mortgage, you're going to have less discretionary income. So the retailers, I think, are in for a bit of a challenging time. Costs are still expensive. Everyone's struggling to get staff. So offsetting rising costs in that sort of environment might be relatively tough for those guys.
Jace, the rally that we've seen for global stocks has been quite compelling. The S&P from trough to peak is up by as much as 15-16%. Has this rally got much more to go?
It's a good question, and for those that I guess were fairly bearish and maybe cashed up through May, June, they're, I guess, starting to look at the rally going, well, have we seen the bottom? Was June the low? There's a fair bit of cash on the sidelines. It is a tricky one. We still think, there's going to be more interest rate rises. I mean, the next Fed meeting in the US is not till September, so you've got a period of time. August is typically pretty low volume. I mean, Northern Hemisphere is largely on holidays. But the rally keeps going. It looks like retail are back. Looks like some of the stocks driving this. Reporting season was good though in the US. I would have thought versus expectations. So like whenever the market moves that quickly, we sort of use the rubber band analogy. It's probably stretched or getting to the point where it might need to have a little breather. We don't think it's going to revisit the June lows until we get some new data that's worse than expectations, and we're probably not going to see that for a little while, if at all.
In terms of the reporting season, are there any particular insights that you're waiting for out of this month before you sort of deploy more money?
Oh, not particularly. I mean, it's a great time to see the management teams and just speak to what they're seeing. They disclose a lot of information, but you can still glean a lot of anecdotal. Still probably early days.
Is there a theme that's coming out of those conversations for you?
Costs. I think there's some industries that have clearly got some great mechanisms to pass that on effectively to consumers at the end. And they seem to be okay. There's others where that mechanism's not entrenched or contractual. And I think they're going to struggle, but we probably maybe haven't seen the worst of that yet. Still not a lot of guidance.
Who's doing the best and who's doing the worst job, do you reckon?
Look, it's probably a bit early. Clearly, if you've got commodity exposure, you're doing very well. And as you point out with BHP, the numbers are huge. I think essentials will probably do okay. I mean, Telstra's result was out. Not super exciting, but fairly steady. They did increase their dividend first time in 8 years. I'd argue your mobile and your broadband's an essential service. They're trying to do contracts to CPI, which would be a regular increase. And that sort of business, you would argue, should get a fair bit of leverage to the network, as opposed to variable costs going in line. So those sort of businesses probably do quite well. Anyone that's got variable costs though, Downer came out yesterday, and I use them because they've got 50-odd thousand employees. I think they're looking for 3,000. Employing people, staff turnover, overtime to fill, still what are fairly high levels of sick leave and absenteeism with COVID or other illness. So I think those businesses that have got a high variable cost, and if that's largely labour, are going to struggle, I think. Not so much in the longer term, but I think to not have some margin compression over the next sort of 12, 18 months, it'll be pretty tough.
It'll be a headwind, that's for sure. Look, we can talk for a lot longer, and it's always great to pick your brain. Thanks for coming in today.
Thanks, Tom. Great to see you.
And thanks very much for joining us for the Executive Series.